Well, wasn't that the video? That was great.
Always makes us nervous to see ourselves on videos. So.
Absolutely. Welcome back from break, everyone. Hope you had a chance to step out into some sunshine. And for those of you online, thank you for joining us. Curiosity. A lot has happened in the last year. How many advisors here and online, feel free to raise your hand, have pivoted or added to some international exposure? Look at those hands, how things have changed over the years. Well, you're all lucky that we have Patrice Quirion here joining us today to discuss all things international, all things global. You just saw the list of mandates that you manage on behalf of Fidelity. Very exciting. So if we think a year ago, you were shouting from the rooftops about why people should be pivoting to international, why we should be increasing our exposure, getting out of the US, really diversifying our holdings. Take us back to, why that is still of increasingly important and really why and how that shift has occurred. So take us maybe from the top down and we'll work our way down the ladder there.
Yeah, so first, happy to be here. Good to see all of you. And yeah, I think if we think back of the past number of years where international was really out of favor, I think ultimately led to an overreaction in the market. So as a contrarian investor, I'm always coming back to the investment philosophy, two core beliefs, where the markets tend to ultimately overreact. So tendencies get over-recognized, too much crowding takes place on both sides, on the positive side and on the negative side as well. So that can create opportunity. And the other core belief I have is pretty much everything follows a cycle. We think of cycles as cyclical stocks, but in reality, there's cycles across most big economic trends. Some are shorter, some are longer. The longer ones are easy to get confused with structural changes that will never mean revert. And I think when it's been going on for too long, you get that combination, a little bit like Ramona alluded to, the emotional aspect, like the crowding aspects or the sort of leaving aside aspect of investor behavior. And you put that with very long cycles that, in the case of international equities, had been sort of going against them since really the European financial crisis in 2013. And it led to an incredible divergence of expectations, valuations from an investment standpoint. What do we really think about the value of a business? Ultimately, we can think of investing as trading stock certificates, but ultimately investing is about buying a stake in a business for the next generations. And to get the right price we pay for that business is the core of what we do, in my eyes. So when the markets diverge too much, it creates those opportunities where patience might be required, but where ultimately sort of those gravitational forces to mean reversion should have an impact. So that's been the case for quite a few years. I think what has changed late last year, early this year is two things. One, I think there's starting to be a little bit more potential catalysts on international equities. If we think of Europe, we are potentially moving closer to a resolution of the Ukraine conflict, although there's still no line of sight on there. We have the fiscal spending out of Germany, which could act as a meaningful catalyst to business and consumer confidence, to the construction industry. And if we look at Asia, we are starting to finally, after quite a few years, maybe see signs of stabilization in the Chinese real estate market and the consumer confidence over there. So that's one thing where from very depressed levels, you're starting to see maybe light at the end of the tunnel for Europe and China, which are what matters most internationally.
I was going to say, and we're going to dive into both of those a little bit later because those are two markets that have been key pieces into your portfolios.
Yeah, exactly. And at the same time, I think the level of optimism around the U.S. market that sort of culminated right after the U.S. election last November, I think is starting to maybe have played its course. I think the U.S. market is still performing well, but is increasingly driven by a limited number of stocks tied to the AI dynamic or semiconductors data center. And I think for investors who are starting to get worried about where we are in that AI cycle, I think diversifying away out of the US, the S&P 500 or the NASDAQ, more into international markets that are less exposed to that potentially peakish trend, bring some diversification. I think this has been gathering momentum so far this year. I don't think it's done, is the message.
Absolutely. So you mentioned two things there, the catalyst in Europe and Asia pivoting away from the U.S., all contributors. You did mention the conflict in Ukraine. There's the trade wars that have been going on globally. What has been, this is a very broad question, but the global market impact because of all of that, and really, this will maybe be a lead into the opportunities that you're starting to see.
Right. So obviously the trade wars that are still with us today have been grabbing a lot of attention. A few points that I keep in mind. I think first, initially, like it tends to be the case, the market has potentially overreacted to what the actual impact would be. The reality is there will be some impacts, but the extent to which supply chain will change overnight has probably been exaggerated. It's really hard to move entire supply chains. And it's been happening for a number of years. Sort of multinationals manufacturing in Asia, exporting to North America, have been diversifying away from China for a number of years. So does that accelerate it a little bit? Potentially. But I think we're at a stage where a lot of what is manufactured there for reasons. So the impact was maybe exaggerated. Secondly, we need to think of the impact not only on those supply chains, but the impact on inflation. And at the moment, the market is, I think, declaring victory on that. The data suggests it, but deep down, I remain a little bit nervous about that, and for a couple reasons. I think we've seen inflation easing, probably in part because the economies are cooling off to some extent. But also, I don't think we've seen the full impact of the inflationary pressure that tariffs will cause. I think we will see a lot more of that impact with the back to school, with the holiday season, for the only reason that a lot of what we've been buying for the past 4 or 5 months since the tariffs have been in place was already on US soil, was in inventory, and was not subject to tariffs. Now companies have been sort of buying over the past quarter or so goods that are subject to tariff, which will be on the shelves this fall as we go into the holiday season. So yeah, let's keep in mind that the inflation impact is maybe not fully in yet. But as always, as active managers, when there's a lot of volatility, when there's potentially overreactions in the market, it creates opportunities, and we should be active around that. And it's not only the impact on the fundamentals, which is what we tend to focus on. Like Fidelity, I think of us as an army of analysts trying to really understand the impact on companies. But there's also the bigger impact of risk on versus risk off, which is, I think, becoming increasingly important in this market. A lot of systematic movements, a lot of correlation into the markets. And when you get some risk off periods, it tends to create opportunities that we've tried to seize, not necessarily on the companies that were most impacted by tariffs. But if we go back to the correction in April, one of the hardest hit sector was sort of the technology sector, which is one of the least impacted by tariffs, but was one of the most risk-on part of the market, which came off. So it can present opportunities in parts of the market that maybe you wouldn't expect.
And maybe that's a good segue because your top 10 just came out yesterday. So as of September 30th, we've had a new top 10 if you want to check that out on fidelity.ca. But Intel creeped into your top 10. So maybe just going a little bit down that technology path, talk to us about Intel and how that made its way into your top 10.
Yeah, so maybe to set the ground, and for the ones who've heard me speak for the past number of years, I am not the investor who will be chasing that AI infrastructure boom. I think it's great at the moment. I think it's an open question, how long does it last for? But I remain of the view that this is likely to end badly on the hardware side of things. So, and it's so much of the market cap in the US, but even in global markets, which is certainly not cheap on normalized earnings, which is my approach. So it's a sector that I've been largely underweight for a long period of time. But if we go back in 2022, after the tech sell-off, if we go back in April to a lesser extent and shorter duration, it creates opportunities and the positioning becomes a little bit less extreme in the market. The deltas become a little bit less extreme. And as a result, I will make the portfolio positioning a little bit less extreme. So it means adding to the sectors that sell off quite a bit in a very typical sort of contrarian fashion. So a couple names on that. So you'll see top position in the portfolio is now Microsoft. I'm still largely underweight the Magnificent Seven, but within that group, I think the higher quality, more software driven, higher like cash flow generation businesses is where I'll find interest. And this is the one name that I picked to get a little bit of exposure on the back of what happened in April. And that was before April, but over the past few years, there's a couple stocks within the tech sector that it's always not like a blanket statement, but you find opportunities within a sector. And I'll bring two that are in the portfolio that are becoming bigger in weights because the stocks are working now, Intel, and I'll put Samsung Electronics in there. And both are sort of historical leaders, strategic assets that basically things didn't go their way, either for technology side of things at Intel, missing the memory for data centers for GPU at Samsung. But when the market capitulates on those names and you're not paying for or paying very little for the options of things going right, when you know they are strategic assets, it leads to a situation where you might not see the catalyst like immediately, but if you're patient, things tend to happen. And we've seen it with Intel, now the US government being involved, a lot of the big semiconductor companies taking stakes in the business, and certainly the market's excited about the optionality of them closing the gap on fabs versus TSMC, essentially.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to FidelityConnects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
So you just mentioned contrarian, because for those of you that don't know Patrice, that is what he is. He and Hugo, I would say, are good friends, manage contrarian in very different ways. But anti-glamour actually just resonated with me from Ramona's session, because I would say you also maybe are searching for the anti-glamour in that. Talk to us, and let's maybe take a step back into the regional allocation of the portfolios. Global concentrated equity, international concentrated equity have beaten 100% of peers year to date. They're having a fantastic year. I think that's been part of your strategic weightings to the certain specific regions. Right now, you have a significant underweight to the US, and obviously international would have that stripped in your global. But talk to us about some of these more international markets. You've talked about Europe. Let's start there and what you're seeing in Europe.
So Europe has been the big overweight into the portfolios for the past few years. And it was essentially based on the fact that we were looking at very similar companies in the European continent relative to close peers in the US, a lot of multinationals. And the European names were sort of systematically trading at a discount to the US names. So if you are limited to one market, that doesn't matter. But in my case, where I can really move assets, and we do it like very actively, and we move things materially, it was just more compelling to buy the very similar business in Europe versus the similar one in the US, either because of better fundamentals, but in most cases, because the valuations were very different. So that was part of it. The other part of it is there are some big sectors where I was finding sort of what is priced into those stocks just way less demanding in Europe versus the US. So let's think of financials. For years, I had my banking exposure within the portfolios where, again, some global funds will say, well, I'll own a little bit of financials in the US, a little bit in Europe, a little bit in Asia, and we'll try to pick the best one within each region. Okay, it's one way of doing things, but I don't think that really expresses your highest conviction. In my case, I take a sector like banks, and let's go around the world, and where does it look most compelling right now? Right. And I don't need to be in the other regions where it is less compelling. So over the past number of years, European banks, to me, felt a lot more compelling because of the rate sensitivity, their gearing in earnings from rates going from negative for a very long period of time in Europe to sort of rates that have renormalized. And if you were spending the time to understand the earnings impact of what rates at 2.5%, 3% meant for European banks' profitability, you were starting to make cases where earnings will double, triple, quadruple, like not plus 10%, like massive like step changes. Right. And the market was sort of slow to realize that. So I've been there for a period of time. Now, by the way, I think this is being a lot more recognized, and I've been moving my bank's exposure away from Europe and now into Japan, and we can talk about that later. So it's a combination of, yes, sectors that are more domestically geared that may look to have better fundamentals with some valuation differentials. And lastly, I'll just make a quick sort of side note on my comment. I think everything follows a cycle. And I think one thing that I find extremely useful as a long-term investor is to ask yourself, not only what's doing well globally, what sector, what company, what country, but where are we on those cycles? And I remain of the view that the US is probably more towards like the upcycle part, both on consumer spending, fiscal spending, and corporate spending with the AI boom that we are seeing right now. As opposed to you go to Europe, and we are more, I would say, like mid-cycle in some areas, like government spending, corporate spending, and we're potentially like closer to the bottom on consumer spending. Right. It's been tough for a long time in European consumer confidence. So that brings up a whole bunch of opportunities, especially in smaller cap stocks that are more domestically geared to consumption or construction or housing and things like that. Like all things that could potentially like cyclically rebound. It's a question of when, not a question of if. I don't think 10 years from now, those will still be at depressed levels. So it's a combination of all that led me to Europe. But I think where we'll go next is, to me, that has partly played out. And there are some sectors, I talked about financials, but other areas like anything tied to defense, for instance, that the market now really acknowledges is no longer contrarian, is no longer mispriced, in my opinion. And as a result, we are starting to look elsewhere. And elsewhere means still Asia, especially China. And to some extent, coming back in the US into the parts of the market, call it like the S&P 490, which has not done nearly as well as the rest, where there are pockets of weakness that may become cyclically interesting here.
Okay, so you've already taken us there, so I'll just guide you along the way. Let's go to China. So China, consumer discretionary, I know has been of interest. Travel has been of interest to you. Maybe quickly, if you want to touch on what that looks like. And then you did make an interesting point there at the end, coming back to the U.S. So we know people have been retreating, but what else other than, the Mag 7 is there to see?
Right. Okay. So maybe first on China, I was talking of where are we on the cycle in Europe. I think if you look at where are we on the cycle in China, I think across the board, we are close to the bottom.
Which is great upside.
Doesn't tell you when things will turn, but tells you the risk reward over time is probably tilted in your favor. Especially when the stocks are that cheap. And the interesting thing is usually when you're close to the peak, sort of finance 101, what you learn on like school benches would be, well, when you're close to the peak, you should pay a lower multiple because things will eventually go the other way. It's not how the market works. So when you're close to the peak, people are excited, valuation go even higher, even if it's on peakish earnings. Right. And the inverse happens when the market's really out of favor. Not only are earnings lower, expectations for growth lower, but stocks are also on lower multiples. And that was absolutely the case in China if we go back 12, 18 months ago. This is starting to change. The Chinese market has been performing better year to date and actually started in the second half of last year. I think it's still cheap, but the market's starting to realize that now we are apparently bottoming. And I'm not going and buying sort of across the board. There's still some issues. There's still some structural issues around real estate. I think the banks are still like black boxes to a very large extent. But if you go in part, and there's a bunch of industries with overcapacity, which creates not only domestic issues, but global issues. And I think part of the reason why we are in this tariff environment. But if you think of what will be driving the Chinese economy over the next 5 to 10 years, I think it's a story of rebalancing where the past, like again, back to the cycles. Everything follows a cycle. Cycle, like a number of years ago, was boom in infrastructure and real estate. Cycle over the past few years was boom in manufacturing capacity, increasing quality of variety of products, taking leadership in a bunch of industries, which led to overcapacity. I think the story for the next 5 to 10 years will be, let's rebalance the economy away from infrastructure, away from manufacturing, more towards domestic consumption, service economy. I think that's what's needed. And if you believe that takes place, you have a bunch of now very well established global, domestic champions in e-commerce and travel, in consumer goods. And I still have a lot of conviction on that thematic over the next number of years. And you'll see the biggest positions in the portfolio are companies like Alibaba, like Prosus, which is a holding company where the value is 10 cents.
But alternatives to what we would typically know here over in North America that could really take off and add growth to the portfolios.
Yeah.
Excellent. You mentioned Japan really quickly. I know you recently traveled there. I mean, I think everyone's been traveling to Japan recently, it seems like, in my talks. But I know you were racking up the airplane miles. One of my colleagues gave me a stat. You've earned so many, I think it could take you around the world 50 times. You are such a frequent flyer. But tell us about Japan. Tell us about what's drawing you there. I know you, along with Salem and other global investors, are really seeing it as a hotbed for opportunity. What's your view?
It's a fairly mixed view, to be fair. I think from a shorter term perspective, I talked about like the financial sector. I think there's opportunities as the country is finally lifting from decades of deflation. Now inflation is there. I think they are slow to acknowledge that it is becoming more systemic, notably because working age population is in pretty fast decline right now.
Yes.
So there's labor shortage across the board. Wages are going up and driving the price of everything else. The weak yen has been driving a lot of imported goods inflation, and Japan is sort of that insular island. They import pretty much every like raw commodities, materials. So I am of the view that inflation is more systemic there. And as a result, that era of like zero interest rates is gone. And if that's the case, just like we've seen in Europe, the impact on bank profitability could be very material. So that's one sector of interest. There's interest from a corporate governance or company structure perspective, where historically it's been a very inefficient corporate structure, like lazy balance sheets, a lot of cross-shareholdings, companies that are not always optimizing like returns and margins. And there's signs that there's been talk that this is changing for a long time, and I think there's starting to be increasing signs or examples of things changing, although it's case by case. So this is two positives. The one big negative, I'll leave you with a high-level thought. Chinese competition across a variety of industry is real. We are starting to see it, but I think starting is the right word. And if you think of markets, to come to the US, there'll be barriers like tariffs and others. But to go to emerging markets, think Southeast Asia, India, Africa, Middle East, LATAM, I think we are sort of entering an era where Chinese dominance or high competition in those markets is, we're going to gravitate towards that. And we need to ask ourselves who has to lose. And in a lot of cases, those Japanese multinationals were the market leaders in those markets across like cars, like technology, et cetera, and are at risk. So I think we need to be careful of buying Japan at large because there's a lot of structural headwinds as well.
Interesting. Great thoughts to have here. And I mean, this is just a taste, I would say, of what's available on the global scale. You cover 31 countries. There's endless research I know that you sift through day to day in trying to find the best opportunities, turning over those rocks, as many people use. So before we pivot into kind of the grand finale, if you will, weaving in our rapid fire, we are keeping ours short and sweet, but just a little bit on travel. If you have to personally pick between Europe and Asia right now, where are you going?
Personally, I love Japan. I think it's a fantastic culture. I can understand why people.
So you're on the hype. Got it.
Yeah.
And if you are in Japan, are you at a beach or are you in the city?
I'm more a city guy. I like to see the economy and how business works. You don't see that on the beach.
Excellent. And I know it's not K-pop Demon Hunters like me and Ramona as our last movie watch, but what's yours?
If I have to pick him, I'll go with any of the James Bond movie, like really for me. And by the way, like FID007 as a fun code leads you to global concentrated.
No one will ever forget that now. There you go. You heard it here first, FID007. Everyone's got that ingrained in their brain now.
Maybe not the most popular series right now, but
that's okay. Just to finish up, we have 2 minutes left. I think ultimately the question, especially when looking at the international markets, it goes, why would I buy Patrice? Why would I buy international concentrated equity versus buying just a broad index?
Yep.
Why you?
I'll leave you with a couple thoughts. I think people are starting to realize that maybe the decade of leadership from US tech, AI more recently, I'm not saying it's coming to an end now, but at some point it will, and leadership will move elsewhere. If we ask ourselves where that leadership could come, I think there will be potentials on like China, on resources potentially. We're maybe starting to see early signs of that. Leads you more internationally. But I think if you just buy general international exposure, if you buy like a DEFI or an EM ETF, you'll end up with a lot of large cap companies, multinationals. Like if you buy the DEFI index, you'll end up with like a bunch of big European pharmas. You'll have like SAP and ASML, which are kind of back to the team of like the tech extension that we're in right now. So I think the opportunity is much more to go underneath that and find the companies that will benefit from a pickup of general sentiment across China and Europe, that will lead to better consumer, that will lead to better construction activity. And we need to be a lot more targeted to find those. And this is exactly what I'm trying to do across the portfolios, is not to buy you the big names everybody knows about, but let's find you the targeted exposure that are exposed to thematic, that can have legs to go, that are still cheap, and that is just not that easy to go find on your own. So I think we can play a pretty core role, and also trying to isolate you to a good extent for the day where that tech boom comes to an end, by being massively underweight to those thematic, to those sectors, and to those correlation that run pretty large as well. So contrarian take and much more targeted is what I'd leave you with.
And you have the Fidelity reach at your fingertips to help you in that search.
Yeah.
Patrice, thank you for joining us today.
Thank you.
Appreciate your global search.
Thanks for watching or listening to the FidelityConnects podcast. Now, if you haven't done so already, please subscribe to FidelityConnects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.